Are you afraid to invest, or does the stock market volatility intimidate you? Well, in this video, I'm gonna share with you 7 little known facts that will completely transform your understanding of the stock market and make you fearless. In his best-selling book Unshakable, Your Financial Freedom Playbook, which I'll also link to in the description box, Tony Robbins called them the 7 freedom facts. So let's dive right in. Starting with the fundamental fact, the stock market rises over the long term. But first, let's face it, the stock market is totally unpredictable in the short term, but over the long term, it's very predictable, and it has one direction: up. But this doesn't mean that all companies that make up the stock market do well over time. Some will rise, some will fall, and some others might even fail and go to zero. Nor does it mean that the market always goes up all the time. It does in fact experience some intermittent drops in the short term. But over the long term, the aggregate stock market rises over time. And this has been true for more than 100 years of stock market history, through which the average returns were around 10%. This is why investing in the whole market for the long term through an index fund or ETF is a winning strategy. So always remember, despite several short-term setbacks during wars, political conflicts, pandemics, recessions, and all kinds of economic and financial crises, the stock market has always recovered and continued its relentless upwards climb. But what about market volatility and these short-term drops? And this leads us to the next fact. No one can accurately predict short-term market moves, amateurs and professionals alike. Economists and market strategists from well-known financial institutions and the media keep on making those dire predictions year after year about the stock market until they occasionally get it right. And when that happens, they're all over the headlines. But that doesn't mean we have to believe them. Why? Because the number of times these professionals get it wrong is mind-boggling. Let's take a look at some of the market predictions from various sources, including financial journalists, analysts, and even economists. The list is not exhaustive, and I'll include all the links to these articles in the description box for you to check out. All these articles have two things in common. A, they use scary titles designed to get eyeballs and draw you in, and B, they will all wrong. Dead wrong. Therefore, if you follow the news or financial forecasts and believe any of this information is actionable, then think again. So, how do we protect ourselves from these market drops? Well, we're gonna find out that we don't really have to once we understand the next fact. Market corrections happen frequently. A correction is a drop of between 10 and 20% in the stock market from its recent high. And here's an interesting fact. Historically, since 1900, corrections have happened on average about once a year. The average drop was around 14%, and corrections lasted around 60 days on average before the market rebounded. Again, these are just averages, so it doesn't mean corrections happened every single year or lasted exactly for 2 months. In fact, it's impossible to accurately predict or time these corrections, let alone avoid them. So you need to learn to accept them as regular occurrences in your lifetime, just like winter or your birthday. Therefore, you don't need to worry about these corrections because they always recover. And I get it. It feels totally uncomfortable when your assets are impacted by a correction, which is why many investors panic and sell at the slightest market drop. However, if you hold tight, the storm will pass before you even realize it, and the market will recover and continue its upward trajectory. And remember, this is very important. If you don't panic and sell, you won't turn a paper loss into a real loss. But what about when the market drops significantly beyond just a correction? Again, let us look at some historical facts. 1 in 5 corrections turn into a bear market. Let's quickly define another market jargon. A bear market is when the market drop reaches or exceeds 20%. Historically and on average, 1 in 5 corrections turn into a bear market. In other terms, if you panic and sell during a market correction, there's an 80% chance you're doing so before the market recovers. And again, you would have turned a paper loss into a real loss. Once you understand these odds, staying calm and remaining invested becomes much easier. But what about that 20% chance of that correction turning into an ugly bear market? Before we continue, if you're getting value out of this video, please let me know by hitting that like button on YouTube. Because I'm on a mission to spread financial literacy and the simple rules of wealth we should have all learned in school. So if you want to support this cause, please share this video with someone else who might benefit from it. Back to our topic, and on to the next fact. On average, bear markets have happened every 3 to 5 years. There were 36 bear markets between 1900 and the time of recording this video in 2023. So depending on when we start counting, bear markets have historically happened on average every 3 to 5 years. And the average drop during bear markets was around 33%, and in some extreme cases, the drop even exceeded 50%. That's super scary, you might think, but stay with me. In addition, bear market varied widely in duration, from a couple of months to a couple of years. Again, these are all averages, so it doesn't necessarily mean that all bear markets were spaced out this way or that there's a predictable pattern for them. So what does it all mean to you and me? If you're investing for the long term, you shouldn't be scared of these bear markets either. Because again, it's just a matter of time before they recover. Therefore, remain calm, stay the course, and continue investing during these seemingly scary bear markets. Good investors understand that corrections and bear markets happen regularly. The most successful investors take advantage of these crashes by investing more money. In fact, investing during bear markets will get you faster to your financial goal. Why? That's because you're acquiring shares at a discount that will later shoot up in price when the market inevitably recovers. And here's another interesting fun fact. While people go on a shopping frenzy when their favorite stores are on sale, the stock market is the only place where people freak out when stocks are on discount. So remember this. Corrections and bear markets are seasonal, just like winter. Some winters are colder and some last longer than others. But here's your silver lining. Every winter is followed by spring, which leads us to our next fact. Bear markets always turn into bull markets. I'm not entirely sure what the financial industry has for animal names, but in case you're wondering, a bull market is when there's a significant rise in the stock market, typically 20% or more, over several months. Now hear this. Every single bear market in history has turned into a bull market. There was no exception. So if you panic and sell during a bear market, you'll be missing out on the bull market and the outstanding recovery that follows. This is why it's important to be a long-term investor, not just a short-term trader. Oh, and by the way, don't be tempted to sell out and then reinvest back when the turmoil is over. This is known as market timing. And as tempting as it might seem, the evidence tells us that it simply doesn't work. Because again, no one knows when the market will drop, and when it does, nobody knows how deep it will fall or how soon it will recover. And this is why it's very important to understand the next fact. Being out of the market is very costly. When the market drops, many investors, including seasoned ones, typically stop investing, or worse, they pull their money out to protect themselves from the crash. On the other hand, after a bull market, some investors start getting the fear of heights. And again, they either stop investing or sell their investments to avoid a possible crash that may or may not come. And while this might look prudent at the surface, believe it or not, this has been proven to be a very bad strategy. That's because pulling out of the stock market, even for a short period of time, may be very costly. Let me show you. A study conducted by Fidelity shows that if you have stayed invested between 1980 and 2018, you would have made the amazing average returns of the stock market. If, however, you have pulled your money out and missed just 5 out of the best trading days during that same period, your returns would have been reduced by 35%. If you missed the 50 best trading days, your returns would have been reduced by a whopping 91%. Moreover, the best days in the market tend to be just within a few days after the worst ones. So how on earth are you going to time this correctly? Remember, no one can accurately predict the market, amateurs and professionals alike. This is why staying invested, which means not pulling your money out regardless of market conditions, is the best winning strategy for the long term. Once you understand these dynamics, all your fears of the stock market will just melt away. However, there are some dirty secrets the financial industry doesn't want you to know, and these are costing you hundreds of thousands of dollars during your lifetime. Therefore, I'm gonna pull back the curtain and reveal what the financial industry is really hiding from you. So to learn about these secrets, click or tap this card on your screen because this is a video you definitely don't want to miss. Alternatively, click or tap this card to watch another video. Thanks again for watching, and I'll catch you in the next one.